Welcome back to Hash Commerce and Dollar Accounting. If you're looking to master commerce and accounting concepts, you're in the right place. We'll guide you through every essential topic and practical application, using real-time examples from companies and entrepreneurs to illustrate key points. In today's video, we'll take a deep dive into financial statements, the backbone of any business. We'll cover the three major financial statements, their components, and why they matter. Stay tuned till the end for a bonus tip on how to analyze financial statements like a pro, with examples from companies like Apple and Amazon. Financial statements are official records that summarize a company's financial performance. They provide insights into profitability, financial position, and cash flows, used by stakeholders such as investors, creditors, and management to make decisions. For example, Apple's financial statements reveal its profitability through its income statement, Google's balance sheet shows its financial position, and Amazon's cash flow statement highlights its cash management. The income statement of Apple shows its revenues, expenses, and net profit over a specific period. Key components include revenue, sales, cost of goods sold, COGS, gross profit, operating expenses, and net profit loss. An income statement, also known as a profit and loss statement, shows a company's revenues, expenses, and net profit over a specific period. This financial statement is crucial for understanding the financial health of a business. It provides a detailed breakdown of how much money the company has made, how much it has spent, and what remains as profit or loss. By analyzing an income statement, stakeholders can make informed decisions about the company's operations and strategies. The key components include revenue, which is also known as sales. Revenue is the total amount of money generated from the sale of goods or services. For instance, Tesla reported a revenue of $31.5 billion in 2020, driven by strong sales of its electric vehicles. Similarly, Microsoft generated $143 billion in revenue in the same year, largely from its software and cloud services. Higher revenue indicates strong sales performance, but it is not the sole indicator of profitability. The cost of goods sold, or COGS, represents the direct costs associated with producing the goods sold by the company. This includes the cost of materials and labor directly used to create the product. For example, Tesla's COGS includes the cost of batteries and manufacturing labor. Subtracting COGS from revenue gives us the gross profit, which shows how efficiently a company is producing its goods. Gross profit is a critical measure as it reflects the core profitability of the business before accounting for other expenses. Operating expenses are the costs required to run the company that are not directly tied to the production of goods or services. These can include rent, utilities, salaries, and marketing expenses. For instance, Microsoft's operating expenses include salaries for its software developers and marketing costs for its products. After deducting operating expenses from gross profit, we arrive at the operating profit, which indicates the profitability from regular business operations. Finally, net profit or loss is calculated by subtracting any additional expenses such as taxes and interest from the operating profit. For example, if Tesla earns $100,000 in revenue and spends $70,000 in expenses, its net profit is $30,000. Similarly, if Microsoft generates significant revenue but has high operating expenses, its net profit will reflect the balance. This net profit is a key indicator of the company's overall financial performance and sustainability. Regularly reviewing the income statement helps businesses to identify trends, manage expenses, and make strategic decisions to enhance profitability. Understanding each component of the income statement is essential for anyone involved in managing or analyzing a business. A balance sheet provides a snapshot of a company's financial position at a specific point in time. It is one of the most important financial statements and is used by various stakeholders, including investors, creditors, and management, to assess the financial health of a business. The balance sheet is divided into three main sections: assets, liabilities, and equity. Each section provides critical information about what the company owns, what it owes, and the residual interest of the owners. The fundamental formula here is assets equal liabilities plus equity. This equation is the foundation of double-entry bookkeeping and ensures that the balance sheet remains balanced. It means that everything the company owns, assets, is financed either by borrowing money, liabilities, or by the owner's investments, equity. Understanding this formula is crucial for analyzing the financial stability and operational efficiency of a business. The key components are assets, which include cash, accounts receivable, inventory, and property, plant, and equipment. Assets are typically classified into current and non-current categories. Current assets are those that are expected to be converted into cash within a year, such as cash, accounts receivable, and inventory. Non-current assets, on the other hand, are long-term investments that will provide value over several years, such as property, plant, and equipment. Liabilities, which cover loans and accounts payable, are obligations that the company needs to settle in the future. Similar to assets, liabilities are also classified into current and non-current categories. Current liabilities are obligations that need to be paid within a year, such as accounts payable and short-term loans. Non-current liabilities are long-term obligations, such as long-term loans and bonds payable. Equity, comprising the owner's capital and retained earnings, represents the residual interest in the assets of the company after deducting liabilities. It is essentially what the owners would theoretically receive if all the assets were sold and all the liabilities were paid off. Equity can be further broken down into common stock, additional paid-in capital, and retained earnings. Retained earnings are the cumulative profits that have been reinvested in the business rather than distributed to the owners as dividends. For instance, if a company like Facebook has assets worth $100 billion, this means that the total value of everything the company owns is $100 billion. This figure includes all the current and non-current assets, providing a comprehensive view of the company's resources. If Facebook has liabilities of $30 billion, it indicates the total amount the company owes to creditors. This includes both short-term and long-term obligations that the company needs to fulfill. Therefore, Facebook's owner's equity is $70 billion. This is calculated by subtracting the total liabilities from the total assets. The owner's equity represents the net value of the company and is a crucial indicator of the financial health and stability of the business. A strong equity position often signifies a well-managed company with a solid financial foundation. Similarly, Netflix's balance sheet shows assets worth $30 billion and liabilities of $15 billion. This results in an owner's equity of $15 billion, reflecting the company's financial strength and its ability to generate value for its shareholders. The cash flow statement tracks the movement of cash in and out of the business. It's divided into three sections. Operating activities, which is cash from core business operations. For example, Uber's revenue from rides and deliveries. Investing activities, which covers cash used for buying and selling assets, like Airbnb investing in new properties. And financing activities, which includes cash from loans or issuing shares, such as Uber raising funds through an IPO. This statement helps determine liquidity and cash availability for future operations, ensuring companies like Airbnb can sustain their growth. Financial statements help businesses track performance and make informed decisions. Successful entrepreneurs like Elon Musk and Warren Buffett rely on them to secure loans and attract investors. Moreover, they assist in tax calculations and ensure compliance with regulations. To analyze financial statements like a pro, use financial ratios such as profit margin, which is net profit divided by revenue and measures profitability. Current ratio, which is current assets divided by current liabilities and checks liquidity. And debt-to-equity ratio, which is total liabilities divided by total equity and shows financial leverage. Also, compare statements over time to identify trends and assess financial health. Financial statements are the key to understanding a company's financial health. They provide a comprehensive overview of a company's financial performance, including its revenue, expenses, profitability, and cash flow. By examining these documents, stakeholders can make informed decisions about investments, budgeting, and strategic planning. Learning to read and analyze them will give you a strong foundation in commerce and accounting. This skill is invaluable whether you are a business owner, an investor, or someone pursuing a career in finance. Understanding financial statements allows you to assess the financial stability and growth potential of a business, identify trends, and spot potential red flags early on. For example, consider how Apple uses its financial statements to showcase its strong revenue growth and profitability, attracting investors worldwide. Similarly, small businesses like local cafes can use these documents to manage expenses and plan for expansion. Entrepreneurs like Elon Musk rely on financial statements to secure funding and drive innovation in their ventures. If you found this video helpful, like, share, and subscribe to Hash Commerce and Dollar Accounting for more insightful content. We regularly upload videos that break down complex financial concepts into easy-to-understand segments, helping you stay ahead in the world of commerce and accounting. Your support helps us create more valuable content for our community. Drop a comment below if you have any questions or topics you'd like us to cover next. We love hearing from our viewers and are always eager to address your queries and suggestions. Your feedback is crucial in helping us tailor our content to better meet your needs and interests. See you in the next video. Until then, keep exploring, keep learning, and keep growing in your financial journey. Thank you for watching, and we look forward to bringing you more educational content soon.